On this episode, I interviewed Nick Karadza. Nick is one of the owners of Rockstar Real Estate. It's an investment brokerage based out of Oakville. I used to work with Rockstar a couple years ago and then transitioned to Keller Williams. But Nick's a great guy. I'm really familiar with him from my days working here, and him and his brother Tom are really knowledgeable when it comes to the latest things that are happening in the economy and in real estate in general. So on this episode, we broke down the latest headlines. We talked about inflation. We talked about unemployment a little bit about digital currency, where the market's heading in the future with the rate cuts. So I think there's a lot of valuable information here. A lot of it is based on data. So they have an upcoming event and they're preparing for that and doing a lot of research. So hope you guys will enjoy the episode. Make sure to leave us a review, ideally 5 stars on Apple Podcasts if you have an Apple device. And if you want to connect with me, you can check me out on Instagram, WellOffX, and feel free to send me a message there. I'm more than happy to connect with you, answer any questions. I look forward to chatting with you soon. All right, I'm here with Nick. I think this is either his second or third time we do this, but anyway.
I think it's second.
Second time? Yeah, I've had Tom on as well. But anyway, it's always good to have you guys on because I know you do a lot of research. You're in the loop with a lot of things here. So we have a lot going on in the market. As somebody who's...
You just called me a nerd?
Yeah, pretty much.
Research nerd?
You guys do a lot of research, like probably more than a lot of other, I guess, groups, right? Like,
yeah, I have no idea. It's just what we like. We selfishly try to figure stuff out. We're trying to figure out what's going on for ourselves. Yeah. And then we share it with people to see if it helps them as well, and if let them make their own opinions based on it. Right. But yeah, I mean, it was it was 2008. We got blindsided during what a lot of people don't even remember anymore. And that's how old I am, I guess now. But do you remember the financial crisis?
I was in university at that time.
So you barely remember it, right? Yeah. So we were. That's what I'm telling you. So we were blindsided. Our friends in the U.S. were down there at a conference, and all this stuff started falling apart, and they were freaking out, man. They had the fear of God in them as like American entrepreneurs, which we never really saw, because to us, the American entrepreneurs were always a little bit more aggressive, a little bit more fearless than Canadian ones. Yeah. And we were down there, and that's when that started all kind of crumbling. And we figured out after that we're like, we have no idea what the heck's going on. So that's when we became more nerds, because before that it was like, just kind of like, let's buy some assets and self-liquidating assets. We buy a few properties and go from there.
So if we go back to that time, the 2008, so really I think like it sparked in 2007, right? That's when the market I forget what it's called,
They called it the Great Financial Crisis. Yeah, there wasn't there wasn't a Black Friday. Black Friday, is that what you were going to refer to?
No, it was not Black Friday. It was Black something. But anyway, maybe I'm wrong.
I forget. But anyways, that's when it all
started. So I think it like kind of started falling apart in 2007. Then they really felt the effects of it after that. Do you remember how long it took for the effects to be felt?
Probably about just over a year, if I remember correctly.
So that's kind of similar to what we're experiencing, because 2022 is when they started increasing rates, and then things were fine. It seemed like for most people, like there wasn't that much of an impact initially, and then you can see 2 years later now we're really starting to feel it. Would you agree with that?
Yeah, I would agree a bit, except in real estate. Like real estate felt it way earlier. Yeah. So I think different sectors of the economy feel it at different points. I think maybe the average person is feeling it now more, whereas I think more businesses felt it in the past, because the business owners I'm talking to, they had larger downturns earlier, and now they're starting to see people kind of come around and come back. But it's also a point where people that have held on, or there's been more recent job losses and they haven't had savings. I think that segment of the economy right now is really feeling a lot of pain. Like credit card debt is way higher than it was. Yeah. And it's historically high levels in certain segments as well. So I think that's kind of what shifted. Whereas real estate's kind of like come back a little bit now, but people aren't talking about it. They're still waiting for like the bottom. But in a lot of areas and places and types of properties, I think the bottom's probably already in, where some areas it might not be.
Yeah. It's just, we'll dive into all that. There's a lot of different things that we can touch on, but so businesses, everybody felt it at a different time. So Do you have stats on credit card debt by any chance, like off the top of your head?
I don't, you know what, I'm just going through, I'm putting this type of stuff together for whatever, 2 weeks. So I don't have them.
Okay.
I just saw one thing it was from the Bank of Canada today where they were I believe it was talking about that in the rental segment, so people without a mortgage, that the number of people that are using 90% or more of their credit card balances is like an not like an historic high, but above historic norms of where it should be. So that's the rental, that would be the renter population. And we're seeing that on the streets with applications we're seeing and things like that as well. Yeah. So, but I'm putting more of that stuff together. That's the only one that I have off the top of my head because I was looking at it earlier.
Okay. Yeah. It's it seems like I'm hearing more of that, but obviously I don't see it firsthand in terms of credit card debt or just lines of credit. But even like people that we talk to, some people, we're finding more and more people are having to sell their homes because the debt's just too much or whatnot. Are you coming across that as, the owner of a brokerage?
Yeah, we're seeing it. I mean, we were more investor focused, so we deal with a lot more investors. So we see what we've seen is investors have over the last 12 or 18 months, they've kind of reshuffled portfolios. Yeah. So if they had a portfolio of 10 properties, they had some that were performing really well, and they had a couple that maybe weren't performing as well. So they're like, maybe now's the time to kind of cut those losses as interest rates went up and those were performing even more poorly or negative. Yeah. Or they had some properties that they've had for a period of time and have served them really, really well. But they refinance those things. Like we've had people that refinance them a couple times. Right. And now they're like, well, the cash flow's so bad on it. Yeah. But that's because they took like $500,000 of profit out. So now with interest rates went up and the cash flow numbers weren't good. So they're like, you know what, I'm going to cut my ties on that one and then keep the rest. So we've seen more of that than the other stuff.
I've come across actually more and more people, listings on the MLS where the person or the company may have bought it a year or 2 years ago and now they're selling it because they have to. It seems like that's becoming more of a common thing with rental properties for the most part that I'm seeing. Would you agree that people are starting to see that more and more?
I think some people that were trying to hold on are got to a point where like I can no longer hold on. I'm curious what the recent interest rates cuts are going to do to that because we're 3/4 of a point down. Yeah, we're likely to see a half or another 3/4 before the end of the year. Right, which that starts to become. That's 1.25, 1.5 point cut. That starts to impact people's numbers. Does that change their opinion? I don't know. I don't know. So it'll be interesting to see. So it depends when they bought and what they bought. Right. Like the Toronto condo market looks still for a period of time, doesn't look like it's going to be a great place to own properties in the short term. It doesn't mean the people that have owned properties there for a while aren't doing very well and it's totally fine. I just mean some of the recent closings might not be great for some people just because of the influx of inventory coming in the market. Right. Right. Well, that was the first headline. So I've got a bunch of stuff here that to talk about. But the first one was about the U.S. Federal Reserve cutting the rate by 0.5 percentage point, which is kind of old news now. If you look at it this way, this was from September 18th. We're recording this on September 24th. But how do you think that will impact us moving forward? Because I think we led the rate cuts as opposed to following what the U.S. did over the last couple months. And that's kind of unusual, isn't it? Well, we led with the increases as well. So, but we kind of, there's very few times in history that when we reverse course or have a different course from interest rates in the U.S., that we don't correct to do what the U.S. has been doing. So we tend to follow them way more than they follow us because, and what I mean by that is even if we move first, it's likely in a direction that they're going anyways. Right. And it's because they know where they're going. So some people look at Canada as almost like the playground for the Fed to kind of test different things up here. I don't know if that's true or not, but that's the way some people are looking at it. As far as the Fed cut, it opens the doors for Canada a little bit more. It impacted our bond yields, right? So because if they think rates are go like lower in the U.S., then they're likely going to go lower here. So it impacts our bond yields, but the bond yield, which impacts fixed rates. So I know you know this, and just for anyone else listening, So those have come down. Those have already come down a bunch. Those come down a little bit more. But I think what it does more is it allows more flexibility for the Bank of Canada to cut if they need to.
Yeah.
And because when we started cutting rates, one risk is our dollar. So as we pay a lower rate, our less people want to invest. Our dollar generally goes lower than if the U.S. if there's a larger gap between Canadian and U.S. interest rates. Because they've come down by a half, it eases the downward pressure on our dollar a little bit. So it gives them a little bit more flexibility to continue down the path versus if the U.S. held steady and we had to continue to cut, it would really impact our dollar in a larger way.
But wouldn't that mean that over the last 2 years, with all the increases that we experienced, I think the increases, were they higher in Canada versus the U.S.?
From bottom to top, I don't know offhand.
Okay.
They were in the same range. I don't know exactly what.
So that's why the exchange wasn't impacted too much, because there were similar increases, right?
Mm-hmm. Yes, except that the exchange was our dollar has gotten weaker towards the U.S.
Yeah.
I'm only basing that off my credit card bill. I don't know if you buy anything in the U.S. and you see the conversion once it hits your credit card bill, you're like,
yeah,
holy crap, it's gotten weaker, right? Yeah. So it has gone down. I mean, typically when the dollar goes down, it's not like this type of thing that just plummets way down. But it has trended that way, right? Because there's a lot of economic data that came out of the U.S. that was showing that more strength in the U.S. economy than the Canadian one. And they tend to revise their data more and in larger numbers than we do here. So I don't know why or how, but I think that was kind of one of the reasons for that too.
Right. You think there is a chance here, if they continue to cut these rates, like they do, a 50-point reduction by the end of the year, and then continue to aggressively cut over the next few years, or over the next year, sorry. Do you think that's going to impact inflation and cause another really hot real estate market, for example, stuff like that?
Yeah, I don't think it'll be hot like it was. Yeah. But yes, I think it brings back inflation, because what they're doing by dropping the interest rates, they're allowing more money to go into the economy more easily. So money creation, one of the ways money is created is when people borrow money from the bank. That's essentially creating new money, expanding the money supply, and then causing inflation. So right. I don't see how it doesn't. I think their stated goal is inflation. Like they want inflation. They've basically come out at their last Bank of Canada meeting. They came out and they said, well, we're now concerned that the economy is weakening and that inflation can drop too far too fast, which means the inflation gets too low or goes to deflation, which is what they don't want in a debt-laden economy. So if we get deflation, that's like bad news. They don't want that. So they're like, oh crap, if it goes too low, we don't want that. We got to start pushing inflation again.
Right.
So that's what they're trying to push up now, hoping that this doesn't keep dropping. So they're trying to get ahead of the curve a little bit. Yeah,
that's kind of what I was trying to get at was, is it too late now, right? Have we just, like you said, credit card debt's really high and a lot of people are kind of in these tough situations. Is it too late for these cuts to cause significant inflation, or what are your thoughts?
No, I think it comes back. I think they don't want these very obvious extreme levels of inflation that we were seeing. But they want inflation and they need inflation because it's the only way they pay off the debt. They either default on the debt, and I'm talking of the government debt. Okay. Either default on it or they inflate it away. There's really no other options. So, and if they default on it, that gets really messy.
What happens?
Want to do that?
Have we ever seen a country default on their debt?
Well, yeah, in other countries, like in multiple places in the world, that have defaulted on their debt multiple times in some countries, and it causes generally. There's multiple things that can happen. I mean, there's foreign entities that can come in. So in the past, there's been like the EU or the IMF or the World Bank. They come in and they start making these loan arrangements with them, and they start taking infrastructure from and resources from the countries as collateral, and it just becomes a messy situation. Ultimately, usually leading to more inflation because then they print a new money, right? And then it just leads to more inflation. So Argentina is a good example of a recent one, and they've been facing double and triple digit inflation. So it's just been nuts over there, and that's why they finally got fed up and they elected a new I don't know if it's a prime minister down there or a president. I don't know what Milei, his title is, who's come in and said, hey, like, we're not playing this game anymore. We're just slashing everything because we got to try to get inflation under control. So they've taken that approach differently. Greece was very close in their EU, and what that wasn't.
That was a while ago.
That was a while ago now. I'm trying to remember when that was. But there was
like 6 to 8 years ago, maybe.
I think it was
like
more. 6 than that before COVID. Yeah, maybe 8.
Yeah.
But they were putting capital controls on the ATMs. You couldn't take out more than a little bit. People were going to the store and buying the washing machine because they thought the washing machine would hold more value than the currency.
Oh, yeah.
Right? And they were trying to carry it home.
Right.
Like, this is what people were doing, because what happens is then people lose faith in the currency. If you're not going to pay your debt, the money goes to worthlessness. And typically inflation skyrockets even more because everyone's trying to evaluate, I don't want to say evaluate, but they're trying to, the value of things, they're trying to hold the value by grabbing other things to hold its value. Right. So that's where things go, like, it goes really squirrely. So for that to happen is like would be, I don't know the last time a country like Canada in this position has seen that type of thing. Like, we've heard of Weimar Republic in Germany and those types of things, but I don't know of like a developed Western nation if it's ever happened.
So that you're saying that the country can get to that point if the debt grows just too much, right?
It can, but the typical choice that other countries have made historically is to try to inflate it away first.
Okay, inflate it away, so print money.
By creating inflation. So, yes. So that's what we were doing before, because when interest rates were low, so when interest rates were called them, what are they, 1 or 2%, and we had inflation running at, call it 5% at that time. The real interest rates were negative 3%, which means that anyone that was saving money, even though it was earning 2% in the bank, was actually really losing money because inflation was 5%. So you have $100 by the end of the year, you have 102, but all the goods you could have bought for $100 is 105. So you're losing money. That extra $3 is essentially how they're trying to rob you and put it towards their debt to pay off their debt from all the stupid spending that the government does. Because they're useless, and they're not completely useless, but they're getting more and more useless. No, like, I used to kind of hold my words a little bit more, but this is where I start to get pissed off. So I apologize because we spend so much money on stupid things that if we had some sort of fiscal responsibility here, then it would change the trajectory of where we're going, and we don't have to do these things, right? And it's why people like you and I look to invest in real estate, because we're like, holy crap, if we don't invest in real estate, we're just going to fall further and further behind, like, because you can't get ahead in that type of situation. So that's where, but this is the way they try to structure the whole economy.
Yeah. Well,
calm down. I'll calm down.
Just thinking about politics, like, do you ever see Canada having a prime minister that's a business owner of some sort, like somebody who was very successful as a business owner and decided to move into politics? Or do you just think there's no incentive for somebody to do that?
Yeah, I agree with what you just said. I think the incentive's just not there. And I think that's what kind of screws things up a little bit, because that's where there's all these kickbacks that happen, and then there's these consulting gigs after you're in politics, where you go to either some sort of law firm or consulting organization, or you get speaking gigs from those firms because you have inroads into the government. All that type of stuff happens because those end up being the incentives, because we're not paying them right, or there's just not enough opportunity there. Whatever it is, it's do you want that job?
Have you ever thought about it, about being involved in politics?
No desire. I'd rather be in a quiet place someplace with a few people that I like than deal with.
Yeah, it just doesn't seem attractive to be a politician. Like, you have all this attention on you, but you don't really get much out of it, right? It's just.
I used to work in a municipal government. That was my first job coming out of school in an IT sector. I would get so pissed off because you couldn't get anything done without like 18 signatures and 5 meetings. And it was just crazy. And it would drive me up the wall. I would leave there frustrated at the end of the day. And I would call my wife now, she was my girlfriend at the time. And I'd be like, I'm so pissed off. Like, I feel like I'm wasting my life away here because the pace of which things can move is so slow. And I feel like it's just getting worse and worse. the way that we've structured the government, how much hiring we've done. Like we're just hiring more and more government workers here. If you look at the employment numbers of the last 5 years, self-employed people are way down. Private employment's pretty much flatlined. And the only employment growth we've had is through government employment.
I did read about that recently, because the economic numbers were dim, but like you said, the only growth was in the unemployment, the numbers look good because of government positions.
Yeah, 100%. So they're like propping up these numbers. And if you know anything about the government, I mean, look, when I was in the government, and I'm sure the 80-20 rule applies there just like the same, but the stereotype of, kind of lackadaisical workday, not too much pressure, not really, aggressive deadlines by any stretch of the imagination. Right. All that was very true. Now, maybe that's changed since I've been there. I've talked to other people that work in the government. They're like, no way, hasn't changed at all.
Right.
But, and so then we're now taking a larger portion of our budget in our economy and putting it towards things that aren't really generating results.
Right.
They're for the most part, they're a cost center. So they're just draining on us, but they produce nothing for us. This is the problem. This is like it's a slippery slope we're going down.
Yeah, it's a big problem that we can't really solve. I don't know how we would solve that, but
to your point about if we had some sort of strong leader to come in, it's not easy because our incentives are 4-year cycles. So someone's got to come in and make big changes, and then try to get reelected in 4 years. And whatever big changes they're going to make are going to take off a number of people because some people are going to be impacted. Yeah. But I don't think there's any other way to do it. But I just don't know if the political incentive's there for anyone to do it.
Right. Yeah. I mean, we can talk about this the entire time, but
politics. But
I'll just go through some more of these headlines. But this one was about the income needed to buy a home in Canada. So in Toronto, you're looking at for July 2024, it's showing you need an income of $208,000 roughly. In Vancouver, it's $225,000. Hamilton, $164,000. What are your thoughts on these numbers? Yeah, like you probably follow this trend. Do you find that this number is increasing substantially, or what are your thoughts?
What are they basing it off of? Like probably a 20%, 25-year mortgage,
20% down, 25-year M, $4,000 property tax.
Yeah. So this is exactly what we've seen, right? When we started doing this, we were renting out a whole home on the Hamilton Mountain for $1,400.
Yeah.
Now that same home generates $4,500. And the reason it generates $4,500 is because there's more people living in it, right? It'd be broken up into 2 units, at least 2 units. So what's happening is there's more people being put into smaller spaces. And that's what it is part of this trend, because I'm not bringing it back to the government, but we got to look back at inflation for a second, because as we increase the money supply, that money supply has gone to asset prices for people to protect its wealth, and incomes haven't held up. So incomes have been growing, depending on the time frame you look at. I think it's since about 2010 by about 3%. Asset prices are roughly about 7% during that time. Asset prices, I'm going by the average sale price on the Toronto Real Estate Board, right? If you go back to 69, same thing. It's about 6.8%. From 69 on the Toronto Real Estate Board to 2024, that's roughly the average increase, the increase in the average sale price on the Toronto Real Estate Board. So this is the problem. So the way our system is structured, this is going to kind of continue to happen, and it creates a problem with like what you're seeing. So the solution to that, or what the trends that have kind of countered that, is more people in the same location, whether it's more people in one property or multi, like meaning multiple units in it, or multi-generational people.
Which is what they
together.
Want, right? They want more units.
Well, they need more units because they're not able to fix it. We're not getting into politics again, so I'll hold back on that. But they've turned to the private investors. That's why they changed all these laws, to turn to the private investors, be like, hey, can you guys create units? Because we've been talking about it for decades, but we haven't done it. So you're putting more people into the same units for affordability, whether it's rent or purchase or whatever, because they built smaller units as well so the same type of trend, or it's just or it's like multi-generational things like that, roommates, that type of stuff, or it's things that impact the carrying costs. So the reason why I was able to get to the point that it is now is interest rates definitely helped because it made the monthly payment lower. And you probably have seen the same trend that most people, they don't care as much about the price of the property. They care about the payment on the property. So if they could buy a $10 million property, but only pay $1,000 a month, they're like, perfect. 10 million it is. You know what I mean? We don't care if we pay it off. We like it.
Yeah.
So then we're going to see more changes. We think we'll see more changes that are going to impact that. Like we just saw last week, the 30-year amortization. Right.
Yeah.
I don't think it's going to stop at 30 years. I think it's going to be extended. Right. And you were at our meetings a few years ago. We were talking about this for years ago. We're like, guys, we're going to see the amortizations extended. It's just a matter of time.
Well, there's some B lenders that'll do it. That'll do over 30. So
And I'm saying but what they did is they changed on the CMHC programs with minimal down payments at a higher purchase price, and then for new construction as well, where you can go up to 30 now, whereas a lot of it was limited to 25.
Yeah, how do you think that's going to impact things?
Yeah,
like the thing is, there's a lot of changes that happen all at once, right? The rates are coming down, but then there's also this extended amortization.
Yeah.
All of these things kind of come in together. Do you think that that's overkill? Like I don't really, you don't know the answer either, but just curious on your thoughts.
It's going to push prices up.
Yeah.
Like it's anytime. We just look back at historical trends. So I don't know. I'm not smart, but I just try to go and understand different types of situations that have happened in the past and try to apply them to today. And if you look at any time that they've made money more easily be applied to real estate prices, prices go up. Whether it's lowering interest rates, extending amortizations, loan qualification easier, whatever it is. That's it's not like it's going to happen in an instant, but it's upward pressure on prices. There used to be 40-year insured mortgages. You used to be able to get an insured mortgage with 0% down with a 40-year amortization.
When was that?
Probably when you were still in university.
Okay. I remember hearing about stuff like that.
Yeah,
back then,
I don't know. I think it was probably 2008, maybe.
Yeah, I wish. Yeah, like those are. I always think to myself, I wish I had just bought one property in university.
There's a guy. Yeah. Oh yeah. There's a guy in this office that bought. Still bought one of his properties. I'm pretty sure it was 0% down.
Yeah.
Could be wrong. Might have been 5% down, but it was a 40-year am. Rental property. Yeah. That's what he bought. And it cash flowed. It cash flowed very little amount.
And back then you can negotiate to have the seller pay your some of your fees, right? Like your lawyer fees, like stuff like that.
You still can. It's just when you started doing that in a more competitive sales environment, it got a little bit more difficult because some sellers didn't want to. But there was you think you
could still do that? Because I don't know if a lender sees a clause like that in the agreement, they might say we won't accept that.
Some lenders didn't like it before, and they're just like, oh, that's like a buyer rebate. We might take that off the purchase price. Yeah. But the vast majority of them don't. It was up to do with the amount. Like if you're like, oh, so we're going to do like a $20,000 credit back, they're like, what are you talking about? But when it was like $3,500, it was the vast majority. And I'm talking all like the big banks would take it. It was similar to when it's less than the amount of a furnace these days, right? So so it really depends on.
Have you seen that recently? Anyone write that into an offer like that? The seller will cover the buyer's lawyer fees.
We haven't seen it recently, but because the environment before was so competitive.
Yeah.
And I just don't know if people have tried. I don't even know if people have tried to do it since. But that's why we haven't seen it. We haven't seen it recently. But when properties were selling in 48 hours with 20 offers, that puts you at a competitive disadvantage. For sure. So it wasn't, but we have seen more favorable buyer terms over the last 12 months. Yeah. Than we've seen before. Have you seen any creative kind of clauses or creative solutions that buyers have used in the last 12 to 24 months? Yeah, for sure I have. I just can't recall them off the top of my head because there's been situations that have come up. I just remember thinking like, oh, that was a good one. You managed to do that. Oh man, there was one deal that just came up and I'm trying to remember what it was, but I'm the worst at recalling those types of situations. But yeah, there have been instances where buyers have been very happy with the circumstances at which they're buying the property over the last 12 months. There was one instance that came up where the appraisal came in short on financing, so they were going to walk away from the deal. And that's normal right now because the appraisers are being told by the banks like, hey, I want it ultra conservative, right? And the banks pay them, so they want to make sure they're protecting that relationship. And I feel like it came in about $80,000 below where, we got a fire truck going by.
Yeah.
I don't know if it's picking up the mics or not.
Probably.
But yeah. But so I think was it 80,000? But it was a good number. It was either right up below 100 or right above 100,000. But the seller still wanted to walk away from the property. It's like, I'm done with it. I want to be away from this property. So they ended up they went back. So the buyer was going to walk away. The seller went back and said, hey, you know what? Why don't you just buy it at the appraised price?
Oh yeah.
And the buyer was like, jackpot, no problem. I was happy at the other price. It was just the appraiser. I didn't want to put the extra cash down for the financing, but so they jumped on it. Yeah, so they were like over the moon with it, right? So you're starting to see some of those types of things come up if people are just looking to get out of a property for some reason, for whatever personal reasons that person had, they were happy to unload it at a lower price.
Yeah, for sure. It seems like, it seems like in today's environment, there's a lot of people that have to sell. Like I'm talking about people that have their places up for sale, but they're just not willing to come down from the price. Like
right.
This is what I want. I don't care if I'm going to lose everything. I'm not selling for less than this. Right?
Yeah. There is a bunch of that still.
Yeah.
They just refuse to, because of where some prices were for some areas, and they're not there anymore. They're just like, I don't care. I'm not selling.
Even rental properties, like I don't care. I'll keep it empty for the next year. I just want my price.
Yeah. Their emotion gets involved for sure.
Yeah.
That can be a dangerous way to make financial decisions.
Yeah.
For sure.
I had, speaking of appraisals, so I had a property that I recently was refinancing. Appraisal, so I have 4 townhomes. They're all side by side. The first townhouse that I refinanced, the appraisal came in at 505, and this was in February of this year.
Okay.
I did another appraisal to the unit right next to it. It came in at 445 a few months later. And I was like, okay, well, this sucks. Like I'm getting, 50,000+ less. And 3 days before I close on the deal, they said they revised the appraisal and reduced my loan amount even further right before. So I'm like I can't, I'm not going to do it. It's just too expensive to refinance the property for that.
We saw same property get appraised by a $200,000 difference in 1 week. Same property, 2 different appraisals, $200,000.
Yeah.
It's just like, it's one of the battles right now, because it's a lot of them, some of them, the appraisals coming back just don't make sense.
Yeah.
Like they're just, they really just do not make any sense.
Yeah. I used to like refinance a property. I didn't care. I didn't really factor in all the fees and everything, but now if I look at all the fees, it was going to, like a third of my loan amount was going to go towards breaking my old mortgage and like all these things, right? So it doesn't really make sense in that situation. But anyway, let's move on to the next headline here. So I don't know if you're familiar with this, but it was just something that popped up, but it's about China. So looks like they're aggressively trying to stimulate the economy. Do you know what's going on there and how that could impact us?
Yeah. Is it 600 billion they're putting back in?
I didn't look at the details, but yeah.
So they're doing a couple different things. I think they're changing. Well, I mean, people can look it up, but I think it's something to do with bank reserves, and they're I believe they're directly injecting money into the markets. Maybe not them, but through intermediaries. They're injecting money into the markets to kind of prop up their economy. And it's basically what we're seeing here. They might just be further down the road and be doing it more aggressively right now, whereas they're trying to prevent the economy from slowing. And to prevent the economy from slowing, they're now stimulating it with more funds, which is inflationary, which tries to drive demand, right, and stimulate demand in that way. So it's very similar to, I didn't look into all the details, and I just saw it all this morning, but it's very similar to what we've done in different times here in North America, primarily in the U.S., where there's low rates, quantitative easing, and those types of things. We've seen that time and time again. Just not last spring, right? It was in the spring 2023 when there was the kind of mid-level like banking crisis in the States, and what they did is then they had the program where they were reevaluating bonds, even though the value of the bond had dropped so low. They were telling these banks, like, don't worry, just you park the bond with us. We're going to give you the full value of the bond. So even if you bought a bond at $100, it's worth $10 now. They were giving you the full value, which is just another form of injecting money into the system to prop up the system, to inject liquidity into the system. It's exactly what they're seeing in China, and it's what we're going to see more of here.
Do you think that's going to have any sort of impact on our economy in any way because of how the size of China's economy?
I think everything's so interconnected now that the answer is yes. Like, I think it's so, there's, especially even between America and China, and we're so tied to the US that, everything's just so interconnected that when money is flowing somewhere, it impacts things. And, we used to see that in the past when we had a lot of money from China coming into Canadian real estate. I mean, it was no secret. There was piles and piles of money coming in primarily into the Vancouver area initially. And then they put some foreign buyer laws in place. And then a lot of that money was redirected into the Toronto area. So if we got to a point that it was the same, at that same level, which was extreme levels, but so maybe we're not going to go there again, but at 100%, it can impact things here. It's just at what level is it going to?
Right.
Probably a little bit less a level now than it probably would have a number of years ago.
Sure. This next topic, I think you guys really like. You always talk about it, but this was about the Bank of Canada. They shelved the idea of a digital currency. So this is actually the first time I kind of hear that the Bank of Canada was considering it, but do you have any information on, or do you see this happening? Do you see Canada getting rid of all paper currency and just using digital?
The questions you're asking me is like you're trying to get me ticked off. So I think they're going to. Yeah, I think 100% they're going to because they want control.
So here it says that the research project started in 2017. So it's been a long time.
Yeah, I remember when they put the first postings up.
Yeah.
First they had a press release, they're going to look into it. Then they had job postings for people that they were hiring looking into it.
Yeah.
I should have applied.
So okay, you're saying they want control in what way?
Yeah, so I think 100% sooner or later we're going to have a digital currency. I hope that's not the case because what happens in that scenario is they are able to. So the reason why I think they want it is the same reason why I think it's bad. Okay, if they have a central bank digital currency, they can then stimulate the economy and say, okay, well, here's what we're going to do. We're going to try to stimulate the economy. Everyone gets $1,000, but you can only spend it in these places or whatever, And some people will look at that as a good thing. But the flip side of that is what if you do something they don't like? Or what if they incorrectly assess you on your tax return and then you're like, well, no, I'm not going to pay you the $10,000 you think I owe you because I only owe you $5,000. They're like, okay, no problem. Boom. And they switch off everything. They switch off your digital wallet, switch off your digital ID. And some people consider this as like a far right conspiracy theory thing. Yeah. It's not at all. Like this is what happens in other places of the world. And this is also what has been spoken about at different times by different leaders of things that they're looking to do. So is it something that they would look to do for those reasons? Yes. Do I think I hope there's enough pressure against it that doesn't happen? Yeah, I hope so. Because I think the cons of that system outweigh any pros. And that's how I look at it. But it gives them, their stated reason for doing it is it gives them greater control over the money, for greater control over the economy, to then stimulate or pull back the economy to kind of like put it, do the proper amount of stimulation in the economy to keep it at the level they want it at.
Sure.
Right. But there's a lot of downside that comes with that as well.
Are you able to think of any countries that currently have a digital currency?
No, there's different countries that have done different things and different trials and things like that. But there's a lot of them that have they do have control over different things. And a lot of them are more communist countries. And China for a while, like China's full, in a lot of examples, China does have like it's kind of like a social credit score system where they're using face IDs for a lot of different things. And depending on who you are or what you've been up to, you might not be able to access certain things when they scan your face.
Right. I've heard of that actually.
Right. Yeah. So this is like, this is like real stuff. This isn't like, oh, that's some crazy tinfoil hat stuff. This is like real stuff that people are looking at. And it's in white papers. It's in IMF white papers. It's in this thing. It's not in these like, the depths of the internet forums or something. Like this is the International Monetary Fund white paper discussing why they're evaluating digital currencies and explaining this is what they'd be able to do with them. So that's what we base this type of stuff off. But I think the downfalls to that far outweigh any positives. But I also believe I'm someone that believes in some privacy and independence, and not the government supporting you for everything, and like those. So that's just my personal beliefs. So if people don't like that, they can disagree with that all day long.
So on that note, let's touch on Bitcoin. I know you and Tom were really big on Bitcoin. I think you still are. Like, you still talk about it a lot. But has your opinion of it changed at all in the last couple months, maybe couple years?
Yeah, the only thing the primary thing that's changed is, I think, the probability of Bitcoin's ongoing success has probably increased. So Tom and I would have different discussions back and forth, and I'd play a little bit devil's advocate. I'm like, well, they'll just do this to shut it down. They'll just do this to shut it down. Even though I was a fan and a believer in Bitcoin, I was always trying to be like, okay, so what am I missing here? But as certain things have happened, I feel like the probability, not that it's zero, because anything can still happen, but I think the probability of it, maybe being made illegal by certain countries and things like that, I think that probability has dropped a bunch. I don't really see, I don't see that as much of a chance as it had before. But yeah, I'm 100% believer in it, especially with what it seems like is going to happen from an inflationary standpoint, because of the amount of debt we've racked up. If you look at the inflation numbers, if you look at the money supply numbers, they've just increased faster and faster and faster. And with that, we've seen asset prices start to increase faster and faster. So if you have an asset that we can't create more of, that's got like a digital scarcity that's coded, and that people are starting to view that way, more and more people are viewing that way, then I feel like it's got upside to it. And I don't mean upside just from price, because I want, certain people that are betting on it because they're like, price is going to go up, and I get that. But I think it gives people options in life in general. You can move it, you can control it, you can own it. You're kind of a little bit out of the system, if that makes sense. And in some ways that's good.
So over the past couple of years, this is obviously, you're not giving advice to anyone, just kind of your experience.
No, I give zero advice.
Yeah. But over the past few years, would you say you've allocated more capital towards Bitcoin, precious metals, or real estate? Or is it kind of equally spread?
No, it's probably Bitcoin. Not so much precious metals anymore. Real estate, and the reason there is because, like, I had a bunch of real estate already. So that's kind of why it probably went that way, right? So if I had zero real estate, maybe that number would be different. But I think that's why that number probably went that way. But I don't actually know the number. If you consider the value of the properties or something, then it's not that. But if it's just like down payments or like the actual cash out to there, then maybe it is that.
So moving forward over the next, let's say 2-3 years, do you see yourself buying more real estate or just continuing to focus on Bitcoin? Just kind of what direction are you going in?
Yeah, that's a good question. So that's a conversation I have with myself every day.
Yeah.
So I don't know. We were talking about it earlier today, Tom and I think there's a place for both. So the way I look at stuff is I believe that you need income and savings. And, so savings are however you view them. Like, maybe savings to you is your checking account. To some people, it might be gold coins. To some people, it might be some Bitcoin. Whatever those savings are, that's your kind of savings bucket. But I still think you need income. And in this world, like, I look at these real estate properties that we have as it's like a nice little business that spits off income. And then, like any business, when we have income come in, then you can take that income and put it into savings. And a portion of those savings, I think, should be in Bitcoin, because I feel like that's going to protect the purchasing power of those savings more than just leaving them in the bank account. So if we just take into the properties as an example, and I want to renovate a kitchen down the road, and I'm able to save some money, call it $5,000 a year for 10 years, that gives me $50,000. If I leave that in a checking account well, then I don't know if that's what kind of kitchen that's going to get me. And I feel like if I put it in Bitcoin, because it's over a longer term, because Bitcoin can be very volatile. So if I need it in 6 months, this could be a really, really bad move.
Yeah.
But if I'm putting it over for long-term planning, I feel like with that $50,000 of savings over time put into Bitcoin, will be able to still provide me the kitchen that I was able to get today with that money versus something that's half as good, or I can't even buy the kitchen anymore if I leave it in the checkings account. So that's kind of the way I look at the two baskets. I think there's a place for both.
Yeah. So on another note, in terms of real estate, so a couple of years ago, everybody was getting variable mortgages left, right, and center. That was the best kind of option at that time. Have you locked in your mortgages if they were variable, and moving forward, do you see yourself going with fixed, or do you think it's better to stick with variable at this point?
I think it's still better to stick with variable. We just locked one in. 3 years. We just locked one in at 4.39 or something like that.
Yeah.
And I'm already looking at and I knew, because there's the simulation spreadsheets and things like that it looks like variable would probably be the better option, especially because it's the rate of which has come down, and that where 5-year rates might head, and then you can lock into a 5-year at that time at a later date. So we waited until the day before the mortgage is up for renewal to actually look at it. So this was part of the problem.
Yeah.
Okay. So don't do, that's not advisable. And then we were like kind of in a panic to do it. And so we did it. We ended up going with the 3 years. It was a relatively small mortgage. It didn't make a huge difference on payments. But after doing it and looking at a couple other things and kind of reevaluating where things are, I would be like, if we had one coming up tomorrow, I would go variable all day long. I like the flexibility of variable. I always have. And I know it burnt me over the last couple of years, right? It served me very, very well for like when everyone was telling us to lock in, and from 2008 onwards, we didn't. So for 12 years, it served us well. For 2 years, it didn't serve us well, right? But we could have locked in at any time. Don't know why we didn't. Long story. Let's not even get into it. I actually don't know. I don't have a good answer for that. We could have locked in at any time, which is nice. Also, you can break the mortgage. You can break the mortgage with a relatively small penalty because it's 3 months interest when it's variable. So it's kind of nice that way. So I like the flexibility that it gives.
Yeah.
And so far it's served us well. So for me personally, I'd go variable. But for people that can't sleep at night with fluctuating payments and they need spreadsheets to calculate their cash flows 5 years out and stuff like that, then go with a fixed.
That's the same answer you used to give a couple of years ago.
Yeah,
it's true.
There's no right answer for that.
Yeah.
But for me, it's variable. Yeah. Because even locking this one in, it was a few weeks ago, I'm just looking back and I'm like, damn it, why did I do that? So that's where I'm at.
Yeah. Last question on my end, then I'll leave it with you if there's anything else. How are you using AI, if you are at all, now in your business?
Yeah, we're seeing it's more our teams using it. So we use AI as well, but we see in the business people are using it more. The team for different things. They're not using it to do things, but they're using it to trigger ideas for things. Okay. So whether it's images, not so much video. We're not using it for too much video, writing, that type of stuff. They're using it for different things. So I'll give you an example about with the event that's coming up. We have this pirate theme. So they write something, some of the stuff that we're trying to do, they wrote it out and then they throw it into AI. They're like, hey, can you reword this as like in pirate language? Yeah. And then because I was reading this one thing, I'm like, oh my God, man, you guys came up with some awesome terms. Like, this is great. This is so cool, right? They're like, oh yeah, that was ChatGPT. Yeah. So they're using it for stuff like that. We don't use it for too much other than those types of things. What we're seeing is there are a lot of people that are starting to do different things with it around real estate. So specifically like real estate searches. So there's people that are they're trying to get exports of the TREB database, for example, and link it with like ChatGPT. So you can do like searches through ChatGPT onto the TREB system and stuff like that. So that'll get really interesting for those types of things. We're seeing someone else that is gathering a bunch of different data points to make like like a used car report, but for properties, where they're being able to gather anything from like police reports and building permits and liens on properties and just anything of public record, and all combine it into one through all the different APIs. I don't know if that's considered AI or not. So we're starting to see a lot of that stuff, and you'll see more of that stuff. So I think some cool stuff's going to come down the pipe. I think what's going to be really cool is, for me, I just don't know why more like the home builders aren't doing it yet. Because the virtual staging, because it's pretty easy to get a photo of a property and do some virtual staging. Just think when someone's got, you go into the home builder's office, and maybe they are doing it. I know someone was working on it, but I haven't seen it anywhere. And for the upgrade appointment, you put on your 3D goggles, and they're just tapping on like, which upgrades do you want? So if you're in the kitchen again and you're like, oh, do you want these upgraded cabinets? Boom, here's what they look like. And then you see that upgrade like firsthand right away, or you see the flooring change, or you see the tile change there. Yeah. I mean, that to me is like, that's cool. Yeah, like it's going to be cool. I see that coming down the pipe for sure. And because I just see it as a profit center. Yeah. Because when you could see it like that, maybe like they're not going to show it with the price tag, let's be honest. Yeah. Right. But and maybe I might not be as bad as but if my wife sees the kitchen, she's going to want every flippant upgrade that they push. She's going to see it. Yeah. She's looking around with the VR goggles. She's like, oh my God. So there's it's just low hanging fruit. Yeah. And I feel like that's got to be happening very soon. Yeah. Yeah, I never heard of that, but that makes a lot of sense. Yeah. Yeah. Yeah, if I was a tech guy, I've been working, I think it was 2 years ago that we first got that idea. Someone came to us and they were working on it, but I think they didn't follow up on it. And I was like, man, that sounds like a great idea. I'm not a tech guy.
So let's talk about that event you mentioned, the pirate event. Tell us a little bit about it.
The pirate event. Well, it's a pirate event because it's anti-government. No, that's not the case. So it's called the Your Life, Your Terms event. So if anyone doesn't know what we're all about, company name's Rockstar Real Estate. The reason it's Rockstar Real Estate is we believe you invest in real estate not to become a landlord. You invest in real estate to live life on your terms. And that's what we call your rockstar life. And whether it's partying in Vegas or sitting on a hammock reading a book, that's your life on your terms. So the event's the Your Life, Your Terms event, and it's because it's about more than just real estate. There's 100% a real estate focus, but it's about more than that. And this time's really cool. This time there's probably a little bit more real estate focus. We have people coming in from multiple different aspects of the market. Because of the state of the market right now, everyone's kind of looking around being like, hey, so what is the future of real estate here? Yeah. So we have one of the biggest capital allocators in this area. I think it's the biggest capital allocator in this area coming in. We have a guy that's doing a ton of info projects into Toronto, for example, buying a single family building lot and turning it into 10 units, right? So he's coming to share those strategies there. Someone really focused on the rental market, doing management and rentals in multiple different areas of Southern Ontario. Another developer that started with a single family, I think it was student properties they started with. Now they do mid-rise condos on the east side of Toronto. So it's getting an idea of what people are doing in different aspects of the market to really understand what's going on, right? And then we'll dive in with the local market update. Tom does his economic update. We have one of the probably the biggest Bitcoin trainer coming in, BTC Sessions. I don't know if you've heard of him or not. No. So he's coming in too. So there's a lot of different things going on, and it's a solid group. Like what the difference in this event is, it's probably a downfall of Tom and I. We're not hypey people. So we're get past all this BS hype stuff. We're like, okay, just give us the meat and potatoes of everything. Yeah. So we kind of cut to the chase a little bit, maybe too much sometimes. So it's more about that, and about 80% of the room, because of that, I think 80% of the room are active investors. It's not theoretical. It's what's really going on. Yeah. So that's what that event's about. It's yourlifeyourtermsevent.com if everyone wants to check it out.
We'll make sure to link it in the show notes.
Sure, yeah.
There was one more thing I was going to ask you, but I forgot now. Anyway, it doesn't matter. We went through a lot of different stuff. So thank you for sharing all that.
Yeah, I appreciate you having me.
Yeah, it's always great having you. I'll have a coffee after. I'll check it out. And
if it's no good, the coffee's no good, make sure you tell Tom, leave a note on his desk, okay? Leave
the coffee's no good.
Your coffee is no good. You talk a big game about your coffee, but it's really not.
There's too much mold in your coffee.
Oh my God, yes. Please, yeah. That'd be great.
Yeah, okay. I'll leave a note for him.
Thanks, George.
All right. Thanks for listening to this episode. Your support is truly appreciated. And if you can share this with a friend or family member that might benefit from the information, remember our goal is to motivate and inspire others to take action and to build wealth and to become well off. Enjoy the rest of your day.